Hi everybody, and welcome back to video number 4 in chapter 15. And when we left off, we were looking at restricted stock awards. And here's an illustration. On January 1, 2025, Sparks Incorporated issued 1,000 shares of restricted stock to its CEO, Lisa Leslie. Lisa Leslie's a good Trojan, I believe, that played basketball for us. In any event, Sparks stock has a fair value of $20 per share on January 1, 2025. Additional information, number 1 here, the service period related to the restricted stock is 5 years. Vesting occurs, number 2, vesting occurs if Leslie stays with the company for a 5-year period. And 3, the par value of the stock is $1 per share. So, what entries should Sparks make on January 1, 2025 and December 31, 2025? To record the granting of the restricted stock award on January 1, 2025, we're going to show that as unearned compensation. And that's $1,000 times this $20. And that will debit. And then we'll credit common stock, the dollar value, dollar par, plus the additional paid in capital in excess of par common stock of $19,000. So pretty straightforward journal entry there. Now, the credits to common stock and paid in capital in excess of par common stock indicate that Sparks has issued shares of stock. The debit to unearned compensation, often referred to as deferred compensation expense, identifies the total compensation expense the company will recognize over the 5-year period. Unearned compensation represents the costs of services yet to be performed, which is not an asset. Consequently, the company reports that unearned compensation in stockholders' equity in the balance sheet as a contra equity account, similar to reporting of treasury stock at cost. So what we're going to do is to record that compensation expense. We're going to take the $20,000, divide that by the 5 years, and each year we're going to debit compensation expense of $4,000 and credit or reduce the unearned compensation of $4,000. So Sparks is going to record that compensation expense for each of the next 4 years. Okay. Now, what happens in the event of a forfeiture? On January 1, Sparks issued the same 1,000 restricted shares to its CEO, Lisa Leslie. Sparks stock has a fair value of $20 on January 1, 2025. And we have the same situations that we had in the previous slides. Now, what happens if there's a forfeiture? So in this situation, we're going to record that with a debit to common stock. That'll reduce that and reduce the paid in capital in excess of par common stock. We'll credit compensation expense for $8,000 and unearned compensation for $12,000. Now, Lisa Leslie only gets that compensation if she stays for 5 years. She's only stayed for 2 years in this case. So essentially, Sparks is reversing the compensation expense of $8,000 recorded through 2026, 2 years. Okay, now restricted stock units. I've only had that one time in my career, and that was with the University of Phoenix. A very strange situation, I thought at the time. Fairly rare that you see it, but it does happen. So on January 1, 2025, Sparks issues 1,000 shares of restricted stock units to its CEO, Lisa Leslie. Each unit has a fair value of $20 per share, which is equal to the fair value of one share of stock. Additional information is as follows. 1. The service period is related to the restricted stock units is 5 years. 2. Vesting occurs only if Lisa stays with the company for 5 years. My vesting period was 1 year. And 3. The par value of the stock is $1 per share. So, what entries should Sparks make on January 1, 2025 and December 31, 2025 to record the issuance of these restricted stock units? Well, the total compensation expense is $20,000. 1,000 shares times $20 per share. Sparks does not make any entry on January 1 because Sparks only provides a promise to provide these units if Lisa Leslie meets the vesting requirements. Unlike the restricted stock awards, no share of stock are issued on January 1, 2025. On December 31, 2025, Sparks records compensation expense of $4,000. That's that same $20,000 divided by 5 years. So again, we will debit compensation expense and credit paid in capital restricted stock units for $4,000. And we'll do the same thing for the next 4 years, assuming Lisa Leslie stays with the company. Now, if there's no vesting, so this is going to be Lisa leaves the company in February of 2027, before any expense has been recorded during 2027. So the question is, what entry would you make to record this forfeiture? And here, we're going to essentially reverse the compensation expense that was previously given of $8,000 recorded through 2026, similar to the accounting for restricted stock and stock option plans. So the debit will be to paid in capital, restricted stock units, and the credit will be to compensation expense, reversing those entries previously made. Okay, employee stock purchase plan. Generally, it permits all employees to purchase stock at a discounted price for a short period of time. The plans are considered compensatory unless they satisfy all 3 conditions presented below. 1. Substantially all full-time employees may participate on an equitable basis. 2. The discount from the market is small. And 3. The plan offers no substantive option feature. So, let's take a look at Publix Supermarkets stock purchase plan. And it allowed all employees to purchase its stock at a 5% reduction from the market price for a short period of time. How should the reduction in price to the employees affect compensation expense? And because the reduction from market price is not considered compensatory, why? Because the per share amount of the cost avoided by not having to raise cash in public offering equals 5%. So Publix does not need to record compensation expense related to this employee stock purchase plan. Simply just recognize issuing stock. So if we look at some trends in stock compensation plans, the major advantage of restricted stock plans are as follows. 1, restricted stock never becomes completely worthless. 2, restricted stock generally results in less dilutive to existing stockholders. And 3, restricted stock better aligns the employee incentives with the company's incentives. Now, how do we disclose compensation plans? The company with one or more share-based payment arrangements must disclose 1, the nature and extent of such arrangements, 2, the effect on income statement of compensation cost, 3, the method of estimating the fair value of the goods or services received, or the fair value of the equity instruments granted or offered to grant, and 4, the cash flow effects. All right, so in this illustration of a stock option plan, the company has a share-based compensation plan. The compensation cost has been charged against income for the plan was as follows: $29.4 million and $28.7 million for 2025 and 2024 respectively. The company's 2025 share option plan, which the shareholder approved, permits the grant of share options and shares to its employees for up to 8 million shares of common stock. The company believes that such rewards will align the interest of its employees with those of its stockholders. Option awards are generally granted with an exercise price equal to the market price of the company's stock at the date of grant. That's always, I might add, what it's been in my case. Those option awards generally vest based on 5 years of continuous service and have a 10-year contractual term. So share awards generally vest over 5 years. Certain options and share awards provide for accelerated vesting if there's a change in control as defined by the plan. So the fair value of each option award is estimated on the date of grant using an option valuation model based on the assumptions noted in the following table. So here's our expected volatility, the weighted average volatility, the expected dividends, the expected term in years, and the risk-free rate. All right. So if we look at a summary of the option activity under the plan, here are shares outstanding as of January 1, 2025, what we've granted, what we've exercised, forfeited or expired, and then our outstanding shares at December 31, 2025, and exercisable at December 31, 2025. And so we have a weighted average exercise price given in the problem, and a weighted average remaining contractual term given in the problem, and so the aggregate intrinsic value multiplied through. Okay, so that gives us our weighted average grant date fair value of options granted during years 2025 and 2024, and then as of 2025, the 25.9 million of total unrecognized compensation. That looks like a good place for us to end this video, and when we return, we'll continue with option activity. Until that time.